That's the Dow from 1900 to 1940. That's a correction.
Yep.
Now, my definition of a correction is twofold. One is that it corrects price, sends prices earthward, and it corrects investor attitudes. You just pointed out a correction that completely and utterly failed to do either.
Good point.
10% corrects nothing. You need to grind investors' attitudes down to earth. And the last time we had a correction that really did that was 67 to 81. That's a correction right there. When Bernanke talks about the failure of the Federal Reserve in the 1930s, he completely ignores the fact that the Great Depression was ushered in by the 1920s. That bubble was, and it was also a consumer credit bubble. That's a staggering example of what a correction does.
Hello and welcome to Capital Cosmos, everybody. Today I have a very special guest on the show I've been looking forward to interviewing. It is Mr., or should I say Professor Dave Collum. Dave, thank you for coming on the show.
That's my pleasure. Our pre-show chat's already looking entertaining. So
yeah. So you just thought we'd hit record and not lose out on any juicy details for you guys. As it goes with all of these videos, nothing in this video is financial advice. I'm not a financial advisor, neither is Dave. So please do your own due diligence. With that said, Dave, for the people who may not know who you are, give us a rundown on your background.
So I was a mediocre student in high school. Kind of picked it up late, junior, senior. I started to get serious. Was an undergrad at Cornell. Got in the side door. My grandfather controlled all the money. And then got serious, did okay, worked very, very hard, 7 days a week, 9 to 11, sort of work hard. And then went off to, I was a genetics major pre-med, went off to grad school in organic chemistry instead. Due to an extraordinary bit of luck, sort of miracle, a nice bit of luck. I got on the right project at the right time and ended up getting my PhD in 2.5 years and coming back to Cornell as an assistant professor. I switched fields again, not from genetics to organic chemistry, but from one area of organic to a different one. Somehow survived tenure, had a fairly long and reasonably illustrious career. I was so far off the beaten path that the optimum for career development is to be, there's the phrase, it'll ring a bell, sort of crowd adjacent. So that you want to have a community, and I kind of had so far out into the bleachers that I didn't have a community, so I was kind of on my own, but it worked. And so for 43 years, I ran a group, and it was what influences me today and my thinking is that we studied an area that was complicated as hell. So there's that, and then it turns out that almost everything we studied turned out not to be right in some way, and sometimes it was fundamentally wrong. Sometimes it was like mind-bogglingly wrong. And so after years of that, when I started studying market structure and stuff, besides the fact that it interested me because of the complexity, I also, I had developed the capacity to look at a bunch of experts who all agree and say, I don't think you're right. And very few people can do that. And I had developed that. I also realized, it was even yesterday, I go looking for the unconventional. I really do seek it out. So I was listening to a tape this morning, and Margaret Thatcher said some quote about consensus is the root to a mediocre life or something. And I don't pay attention to things that everyone agrees on. They don't need me for that. So I go looking for stories that are not being told. Kind of Michael Lewis-like in some sense. And it takes me into dark places.
Yeah, I was just gonna say, you don't need to be the N+1 person to.
That's exactly right, and so I don't need to pile on some topic, and so there's topics that you say, well, you must want to write about that, and I go, no, because everyone is. right? That's being covered. I will write about it if everyone's getting it wrong. I wrote about Ukraine and blamed 100% on NATO back when the cool kids were not doing that, right? So I think my Ukraine write-up was one of the best write-ups I've ever done, actually, where I found that several dozen people who were trying to understand what was going on there and compiled it into a narrative. And they weren't themselves producing the overview. I produced the overview of it. And my conclusion is that we should be sending arms to Putin, not Zelensky, and that we should have let the war not ever start. I think NATO gets 100% of credit for having the power to prevent the war and absolutely refused to do so. So, 500,000 dead Ukrainians thanks to NATO.
Yeah, I mean, Putin came out the other day and said our enemies are not the Ukrainians; it's those that are
NATO.
feeding the Ukrainians, right?
That's exactly right. And there's 500,000 Ukrainian mothers who are saying, this was not worth it to me. And now their wives and grandchildren, because they're recruiting 70-year-old guys, and it's just a meat grinder now. So
yeah, they're pulling people off the streets.
And, right. Yeah. And kids too. Kids, they're at the women. Hitler Youth phase, right? And women. So their recruiting window is 7 to 70, both genders. And so that was all unnecessary. All Putin wanted the West to do is keep their grubby paws off NATO, and we refused.
Right. So I understand the argument to not be funneling money into Ukraine, right. But you also mentioned that we should have been doing that. We should have been funneling money into Russia instead. Can you go over why that is?
Nah, that was somewhat being metaphorical.
Okay.
But I voted for Trump with a shaky hand back in 2016, and for me, the issue that got me to say, okay, I can sign off on this guy was when he said we have to get along with the Russians. And I believe that we needed a strong relationship with the Russians, and he was the one saying it. And so I said, okay. And then what they do, they hung Russia collusion on him, and then they've now got us into a brawl with the Russians. We're actually, when you read about a drone strike in Russia, that's not being done by Ukrainians. They don't know how to fly a drone. They don't know any of that crap. We're doing that. So,
right. It's a proxy war.
It's not only a proxy war, though. The guys who are doing the strikes are Americans.
Yep.
Right? F-16s are not being flown by Ukrainians. It takes years to learn how to do that.
Yeah. Well, weren't they on the didn't have boots on the ground since 2014, since the Maidan coup?
Yes, and to our great shame, we trained basically Nazis, and I'm not talking Nazis metaphorically. I'm talking guys who, since World War II, have been followers of the Nazi regime, and celebrate Nazis' birthdays, and so we decided that the best analogy between the Azov Battalion, I think, is this: it's sort of at the level of a Mexican drug cartel. They're ruthless. And we armed those guys and said, okay, those are the guys who will fight Russia. And Putin rounded them all up and killed them, I'm sure. I'm sure it was a mass extermination of the Azov guys. And remember the Azovstal siege. He basically corralled them all into the Azovstal steelworks, and then he carted them away. And I imagine those guys are not enjoying a club-fed vacation.
Do you think relationships between Russia and the West could ever be reconciled? Or
it can be, yeah.
You think they can?
No, I think we can. I think we can. I think if we got a president who came in and said, "Look, Vlad, this is stupid. Tell me what you want out of a relationship. We'll try to meet you there." Okay. I think he would do it. Putin, by Western standards, is a sociopath. I've been watching Putin since that 2014 coup in Ukraine. I think that's what caught my attention. In terms of world leaders, he's one of the most impressive. Now, forget about the fact that he's brutal. Justin Trudeau could not run Russia. Biden could not run Russia. Macron could not run Russia. It requires an extremely powerful personality to run Russia. But when you listen, I've watched every speech, I've read everything I can. The guy is laser guided in his thinking. And when he gets asked a tough question, he goes right through the front door with the answer. He doesn't waffle. He doesn't. And so one of the things I like to point out is right now there are two guys in the world who are unbelievably powerful nationalists, real sort of rah my country. It's Trump and Putin. Now, who's getting the most guff in the world right now? Trump and Putin. So I think there's a pattern.
What about
there,
G?
actually.
What about G?
Well, Xi is a total, but Xi's not a see, I don't put Xi in the nationalist category because I think he's a twisted bastard. I think Trump and Putin deeply care about their countries. I'm not sure about Xi. It's too. I tried to read about China this year, and I just got lost in all the Chinese names. After 9/11, I read a half dozen books on the Middle East, and nothing stuck because it's just too foreign. So reading about medieval history, things stick because I go, oh, okay, that's where that comes from, that sort of thing. Reading about the Middle East or reading about China, you just get all this stuff that you have no framework to hang the ornaments off. And so I'm reading a book right now about the history of the Soviet Union through Michael Malice's White Pill. I've been really humping the book. The brilliance of Malice's book is he talks about the brutality. So here's the setup. We know Stalin killed 40 million. What most people don't know is how. So you go, well, he didn't just line them up in front of ditches and just kill 40 million. What he did is he actually caused the entire society to consume itself. And it's an amazing story. And I think the message, and I'm also trying to understand Malice because he's an anarchist, but he sounds like a Goldwater conservative to me when I listen to him carefully. And he somehow does it without getting tangled up in Russian names, and he does it, but it also sounds like a rigorous analysis. But he comes up with key names, so it's very sticky. And so I highly recommend the White Pill. It's mind-boggling, the brutality, and so I highly recommend it.
So wait, hold on. How exactly did Stalin kill 40 million?
So what he did is he got society to turn on itself in such a profound way that everyone was contributing to destroying everyone. So if you walk, if the KGB walked into a town and some guy looked a little healthier than half starving, they'd say, well, he must be stealing food. Then they'd round him up, and then they'd get him to confess to all the people who helped him steal food and by torture, and then they'd arrest them, and pretty soon you had kids ratting out their parents, and you had it became such a convoluted series of people to save their skins, to do the most dastardly things without even being, the ones who get tortured, obviously, but then pretty soon it just became you turned in your neighbor just to be in good favor with the authorities. And then he killed the most prominent doctors in the entire country. He really destroyed the place. And so there was starvation. There was all. It's a complicated story, but it's society consuming itself. And then the message is, to me, although it might not even be possible because who we are, but don't let it happen here.
Right. I was just going to say, the way you were describing it, I see many parallels with our current society.
Right. We're at the beginning. We're at the beginning, but that's the direction we're heading.
So was it a feature or a bug? Like, was it actual policy to stir?
Oh yeah. Oh yes.
Okay.
Oh yeah. Oh yeah. But then the question is why? And I think he was just, both he and Lenin were just twisted. They were just so either drunk with power or it's just psychopathic to an nth degree. That they just thought it was funny. Stalin used to laugh about it. And then what's interesting is Khrushchev took over after Stalin, and he spilled his guts. So we had Western liberals who were defending the Soviet Union, and they were saying, "Oh, I went to the Soviet Union and everything's fine," and blah 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 blah. And Khrushchev came out and he totally blew up that story when he said, here's what we've been doing as a country. This must stop. So our image of Khrushchev is he's one of the bad guys. It would be hard to make that argument based on the fact that he terminated the Stalin regime. Stalin could have been replaced, and instead Khrushchev it's not that life was great, but he dialed it way back.
Okay. So like with Stalin and Lenin, um, like what would they be considered nationalists in your eyes, or were they
No, because
internationalists? Were they part of the internationalist communist
none. I
network?
can't even get a sense of what they were doing. And Malice, I don't think he even tries. I think it's just two power hungry, sick bastards who are just sadistic. And so I think it's conceivable that Lenin had a vision, but it turned so bleak so fast. I said, look, we'll give you civil liberties after we get rid of the Bolsheviks or whatever, and then they kill everyone, and then they go, yeah, but you're not getting your civil liberties. And so they just seem to have a penchant for killing.
Right. And so Trotsky was, I believe, one of the generals in the Bolshevik Revolution.
And then he became the enemy.
And then he became the enemy. And then his students started coming into Western politics as well in the form of the neocons, right? Like, isn't that how?
I think so. I haven't made a so back in the I have an interesting view of FDR. FDR, according to the right, is this evil guy who brought in huge government and this and that. I think it's not that simple. I haven't read his biography yet, which it's in the queue. I get this feeling that FDR was, of course, more of an insider. And what he recognized is that, that capitalism and, top down, bottom up sort of way of running an industrialized society was being debated. And so there were Trotskyites in the United States, and there were people saying, look, in this new industrial world we live in, maybe we need a top down structure. And to the extent that that was a risk, I think it's possible that FDR said, look, capitalism is about to lose unless we protect the forgotten man, to use Amity Schlei's term. And so I think he realized he needed to go big to help the little guy, or they would turn to the left for solutions. Right. And so in that sense, he might have saved capitalism.
So in a sense, it was a kind of a controlled pressure valve release.
That's right. And so I don't know what I think of. I mean, it's FDR brought in all these programs, but you see Hoover Dams and stuff. These were not stupid programs, a lot of them. And he did get guys to work, and they did build parks and buildings. And so he really did the shovel-ready stuff without, I don't think there was anywhere near the graft that there is today. So I think when we do $1 trillion bill, everyone just steals it.
Yeah. And he was also a wartime president on top of that.
And he was a war. So he inherited a pretty tough problem, although it had hit bottom. So he inherited the rise like Obama. Yeah. So, and he made people feel good. So, it's really hard to argue with that, even though you can argue with his big government politics.
Right. So let's go ahead and pivot over from a historical lens to a present day lens. 2024 is going to be chaotic. Half of the world's up for election. There's a lot at stake. What do you see in terms of the market? Is the Fed signaling that they're going to cut rates to kind of elevate or keep the incumbent Biden in that group into power? Or like how do you kind of see the market? Do you see an injection of liquidity just to kind of to do that?
Well, there's a lot of layers to this onion. I wrote a case for a multi-decade bear market. I think we're going to look up 30 years from now and say we haven't gone anywhere. That's what I think.
Mm-hmm. So like Japan,
and that's been done like Japan. If you bought the markets in 1929, inflation adjusted, you were at exactly the same price inflation adjusted in 1981. So if you were top to trough, you can tread water for up to 75 years historically. Right. And so I think we're going to do a top to trough equivalent move. And so I make the case for the multi-decade bear market. Not that there won't be deep dips and rapid rises, and that'll all happen. But if you're a buy and hold guy for the next 40 years, I think you're not going to get shit. So the year always looks consequential looking forward, right? You always say, "Oh, this is the year something big is going to happen," right? But if people miss history, even simple history, like for example, the gold bugs, or people who talk about gold, they say, "Well, gold's going to get hurt when rates go up." And I go, "Did you not pay any attention to what happened in the 1970s, right? Where rates and gold went up in tandem." And then you start thinking about it and you go, well, they're both responding to inflation. So they both should go up. So if we have, you've seen those charts where people are predicting another big inflation spike, like Summers posted, a bunch of people posted.
Like the commodity to SPX ratio.
Yeah.
Yeah.
So now, you'll never hear me talk about history rhyming. I hate trite aphorisms. I make up my own. But I think there are certain patterns that tend to repeat. I think if you look at history, when the Fed pivots, and they haven't pivoted yet, they have simply talked about pivoting, really. The market bottoms are usually a year or a year and a half or 2 years after the pivot. And so people say, "Oh, they're going to pivot. This is fantastic. It's green light." They haven't looked at Fed pivots. The Fed pivot always occurs right before we're about to do a luge run, and that's why they pivoted.
Yeah, it's like if you fall on your, say you fall on your arm and you unknowingly break your arm, you go to the doctor and the doctor says, "I'm going to give you a cast." The cast is essentially the pivot, but that doesn't mean it's bullish for your arm. And your arm's broke. The reason you're getting the pivot is because your arm's broken.
Right. And and then at some point, what is it? We just passed the 34 trillion mark. So it does feel like a doom spiral to me.
It's a quickening.
It's a quickening, and you can't crank up the debt 10% a year or more now. I bet the annualized rate's now much more. With GDP going to be pathetic, in my opinion. It's probably, GDP historically is about 2%.
Yeah.
According to smart guys. And so you can't grow your way out of a 10% growth in debt. And so at some point it does overwhelm you, and it will finally exact its revenge. It always does. You say, "What about Japan?" I said, let's look at what's happened. Now society's okay. But Japan is a very homogeneous society, but the guys who owned the Nikkei in 1989 are still underwater.
Yeah. So I like the fact that you brought up the Fed pivot being a kind of a leading indicator for
that's right.
The bottom, right?
Right.
And at the same time, you also mentioned that the debt burden just gets too large, that the Fed doesn't have that luxury to keep rates at this level. I also want to point out that if there's a lot of people that compare Powell to Volcker, and Powell
they're hoping.
Yeah, they're hoping, but it's not the same. Even if Powell wanted to be Volcker, he can't be Volcker.
Volcker had 34% GDP's worth of debt. Powell has 134% or whatever it is.
And on top of that, I mean, Volcker, debt. We're paying $1 trillion a year just on the interest payments of the debt.
Something like that.
Yeah, and energy. Sure. I mean, granted, we had. I think we had the largest ever, the best year for LNG production and oil production of all time in 2023.
Right. Biggest producer too.
Yep. But it's the energy return on investment ratio. It's getting it's getting a lot harder and harder to extract easy to mine energy from the ground. So, and if you look at energy over time, it's tightly correlated with GDP. So essentially, energy creates value, energy creates productivity, et cetera. So back in the 1980s with Volcker, we had cheap, abundant energy to create productivity and value and grow our way out of that 10, 15% interest rate. Today, it's a lot more expensive. We don't have as cheap energy as we did before. So even if he wanted to be Volcker, he can't do it because there just isn't the energy to overcome not only just a high interest rate, but the debt servicing that goes with it as well.
Right. So enthalpy So society is constantly heading for disorder, right? So if you stopped maintaining a building, within a few years it's gone. And so you do that with the enthalpy of fossil fuels. And now we've got an administration who's got several problems. One is they seem to have no respect for the risk of spending like crazy. So previous feds have said we need help with fiscal policy. And now I think the Fed must be pulling their hair out watching this administration squander huge sums of money on ridiculously stupid things and going, we're trying to tighten up the system and you guys keep spending. I don't see the backbone to stop the spending at all. We will have to hit a bridge abutment and be cleaning up body parts, and then we'll say, okay, maybe we shouldn't do 180 down the New York State Thruway. And I do not believe we can divert it before we hit that bridge abutment. And so now, the Great Depression lasted 10 years. It was a blink of an eye by historical standards, but those 10 years sucked. And so we will potentially dust ourselves off. You don't know for sure, right? We really could turn into a total mess, but I like you, we have land. We have a fairly educated population. We've got factories. We've got capital, but what we don't have are markets that are valued rationally, and we don't have a way to pay off the debt. And I can't picture how it's going to play out though. So I think Powell's also cornered where he can't hike rates to fight inflation because of all the stat. And except he might have to. Now, there's another interesting argument here, and that is I got an argument with David Andolfato, who was vice president of St. Louis Fed at the time. He's now a freelancer. But he said Volcker's policies were deflationary at first, but inflationary at the end. And I go, what, come again? And he said, basically, I think the idea is, but if I understood his case, is that when you have money market accounts putting 15% in the bank every year, for every $1 trillion that's in the banking system at the end of the year, it's 1.15 trillion. And I've still had trouble wrapping my brain around where that money comes from. I've worked very hard to try to do that. I'm not a banker. Someone might be able to tell me, but in a stagnant economy, I don't know where you get $150 billion to dump it in the bank for every trillion.
Yeah. And on top of that, you also add in upward pressure towards, you create supply bottlenecks because it becomes super expensive to finance like, $1 billion oil rig projects, et cetera, with these high interest rates. So you put a bottleneck on supply in the process there by creating further commodity-based inflation down the line.
Yeah. Right? I just read a piece yesterday sent to me by a guy named Dennis Stanek that came from there was a write-up by a guy named David Iben of Copernic, and it was a brilliant analysis of money supply and inflation, things like that. And he basically says, don't pay attention to the little movements. He said, but we're not seeing little movements now. Now it's time to worry. And it was a pretty dark presentation, but the other thing he talks about is that the inflation moves through the system unevenly. We know that, but he says you will see it pop up elsewhere, and as an investor, you have to figure out where it's going to pop up, right? And I once presented to a hedge fund manager that the low interest rates were a consequence of inflation. He told me I was full of shit, but then about 4 years later, he was saying that himself. And what I said was, look, the inflation is bidding up the bond prices. It's hammering on the bond market. And so the bond market should be responding, right? Here's a question I like to ask people. I've done Twitter polls on it too. If you were going to buy a 30-year bond, U.S. Treasury, and you have no idea what the future is going to bring, you just know it's a U.S. Treasury. Could default, seems not that likely. Could default by inflation, very serious concern. But if you had to buy one and you couldn't hedge it, you couldn't sell it, you just had to sit on it as a revenue stream for the next 30 years. what interest rate would you demand?
Hmm.
I'm going to ask you that question. What would you demand?
That's a good
Before you
question.
said, okay, I'll buy $1 million worth of that bond right now.
That's a good
What
question.
would you demand?
Yeah. So probably
Be
a
double digit.
higher, yeah, higher interest rate, right?
Double
'Cause
digit,
30
right?
years
It'd be
down the
double
line.
digit.
Yeah.
Yeah. Well, and then you look at what is returning now and you realize the bond market is mispriced. You say, well, people don't hold them. I go, someone's gonna. Those bonds are mispriced. The reason is there's statutory rules that make pension funds and stuff buy a certain amount of treasuries. And so they, using statutory tricks, create forced buyers. Now, what we've lost is, Chinese buyers, potentially Middle East buyers, Russian buyers, we certainly have lost. And so the petrodollar is not being funneled into treasuries. We're really missing some serious buyers in the international community. And I don't know why we need a reserve currency. I don't even know what that really even means, not from lack of trying, but if you can sell me something in Zimbabwe dollars, if in the keystroke, I can convert that to any currency I want. What's a reserve currency? I don't get it. But as you hear about de-dollarization, I don't think what we're talking necessarily is about the currency. I think we're talking about alliances. So as the BRICS show up, and they started as 4, right? BRIC. And now there's something like 20 countries who are joining this BRIC 2.0. And then the question is that people laugh, they say, oh, that currency wouldn't be strong enough. I go, it's not about a currency. These are 20 countries flipping us off. They're aligning with Russia and China and Brazil
and isolating us.
Yeah. And so it's a shift in geopolitics. It's not about currency. And that should scare the crap out of us because that means they're flipping us off. And we really did have a phenomenal honeymoon period where we got to call all the shots anytime we wanted. I think we've forfeited that. And this is where Putin came in bold. He said, you guys want the reserve currency and then you steal our assets. What reserve currency? What could there be in a reserve currency which is no longer safe?
Yeah.
And now they're talking about giving Russian assets to Ukraine, which is bullshit. It's like when they found an accounting error and found $7 more billion for Ukraine. That's just a bullshit story, right? They're just giving $7 more billion to, McDonnell Douglas or whatever. But when you are the reserve currency, you have to be dependable. And we just showed the world, holy shit, if the US turns against us, they'll debank us. And therefore, what are you going to do? You're going to say, I'm getting out of here, right? If my bank said, look, if you piss us off, we're going to take your money, I would be transferring banks.
Yeah. So the world reserve currency status of the United States, that was one of the most key masterstroke geopolitical moves of all time. Would you agree to that? Or do you think it's actually been detrimental to the United States? Because now the United States is kind of obliged to be the world policeman. So
I read Battle of Bretton Woods with incredible care because it turns out I copy edited it for Ben Steele, and so I read it, word by word, sentence by sentence, and it was a masterstroke. It was also fairly logical. Because we were the only superpower standing, and I think the world needed that sort of Rock of Gibraltar.
The capital went from Europe to the United States because Europe was destroyed in World War II, and
right.
The United States was isolated from that mess.
And we were such a superpower at that point, and so it made sense. But it also confronts what's called Triffin's dilemma, or paradox, depending on who you ask. And Triffin's dilemma basically says to be the reserve currency, you have to run a trade imbalance. We've done a fine job at that. But what also it turns out to be is a suicide mission. You eventually break.
Mm-hmm.
And that's what we're talking about, excessive buildup of debt. And so being the reserve currency is like being it's a suicide mission in which you get lots of chicks and eat good food, but then you're gonna go strap yourself in a plane and hit a U.S. aircraft carrier or something, And so Triffin's paradox says that in the end, you die.
Yeah. So given how the United States has played around with the has used the world reserve currency to their advantage to such a extravagant degree, do you think that the world will ever give that privilege up to another country ever again, say the Chinese yuan, or is something like an agreed upon basket of, let's say like gold and other, I don't know, other assets, would that, like a gold backed CBDC?
But I don't even know. Again, as I'll go back to, I don't know why you need a reserve currency. You can trade everything in a keystroke now.
Yeah.
So you don't have to have big bank accounts full of whatever. If you need to buy oil, you don't need to denominate it in dollars.
Yeah, but what do you think?
Why?
But
Why would
yeah,
you?
yeah, that, I mean, that's a great point. But the bureaucrats that run the world, they may not see it that way. So is that why they're buying up all this gold at these central bankers at record levels? Because whatever comes next is going to be gold backed.
I, yeah, I'm not sure gold will be the reserve currency, but yeah, they're protecting themselves against, the idiosyncrasies of geopolitics. They talk about China's gold. The estimates of how much gold China has actually span a factor of 10, depending on who you ask. And there's people who say, they have 8,500 tons, sort of like the US. There's people who say they have 85,000.
Right.
And since it's the internet, who knows who's right? But China also has a very distributed gold stash, in that they've encouraged all sorts of different financial institutions and people and stuff to buy gold. So there's gold littered throughout China, not sitting in a Fort Knox equivalent, but sitting in various people's possession in various ways. And so it may be that if you add it all up, of course, that's true with India too, right? India has a ton of gold. It's just, it shows up at weddings and things like that.
Yeah, so it's embedded within the culture.
Yeah, it is a time to own gold. I keep getting pestered by the Bitcoin crowd, which I'm sympathetic to, and so I go into Bitcoin, and I'm not interested in Bitcoin right now because I think they're going to have to battle with the state, capital S state, and I'm not sure who's going to win that. And it's also a digital asset, which kind of gives me a little of the creeps, and that I'm sympathetic. The Bitcoin community is somewhere between, Dave makes so much sense. I don't know why he doesn't know Bitcoin, to what an asshole. And to me, that latter is a symptom of a sort of a bit of cult thinking, right? So I don't look at someone and say, you don't own any gold, what an asshole. I would never say that.
Yeah.
I might say, hey, I think you ought to own some. It's a good idea. But people used to ask me what I was buying. I didn't tell anyone I was buying gold many years ago. I didn't tell them until years after I bought the most of it. So I was buying gold from 99 on.
Yeah. I mean,
and I was embarrassed to admit it, actually.
Yeah. I mean, I don't own any Bitcoin or any crypto at the moment, but I plan to sometime soon. Not financial advice, of course, but you do have the cyclical halving coming up. And I don't know if you saw what happened earlier this morning, but the Bitcoin price essentially crashed from 45 to 40,000.
Well, something's happening in the markets. Silver went down almost 3% right away. I don't know what's going. There's these paroxysms in the markets that you don't know whether it's just JP Morgan traders having their way. Death by bongo.
Well, there was there was news out today where they were adding in FUD into the market, saying, "Oh, well, these Bitcoin ETFs might not be approved."
But silver's down 3.4%. So something else is going on today.
What's down 3?
Silver's down 3.4. Gold's down 1.4. So there is some selling going on, but Bitcoin looks like a swan dive. Yeah, it's 6%, negative 6%.
So energy's been doing okay today. Oil's up 3. Nat gas is up 4.
So if you put it, I actually bought some more energy.
Okay.
The other day. Now, I did phenomenally in energy from about 2001 to 2010-ish, 11, 12, somewhere in there. I overstayed my welcome, gave some of it back, but it was a phenomenal decade because I owned gold and energy when everyone else was owning equities and getting crushed. I even had a short position twice during that window. And so from January 1st of 2000 to December 31st of 2009, you think about the pain of those two big bear markets inflicted, I compounded 13%. So that was by far my best decade graded on a curve. I did much better in the late 90s when I was a drooling idiot tech bull, but on a relative scale, very few people kept up with me in the 2000s. Then when 09 hit, I was very liquid, but I didn't buy. And I didn't buy because I saw another halving in the market. And history suggested there'd be another halving. What history didn't suggest is they'd come in with $30 trillion. And if you'd said they're going to come in with 30 trillion, then I would have doubled down and put everything into gold, and it would have been a mistake. Well, I would have done okay from 09, but soon thereafter, gold went into some cup and saucer formation or something, whatever the hell, teacup, whatever they do. So I would have gotten that wrong. So in 2020, I was out of energy from about 15 on. Ironically, not by choice. I didn't even notice for a calendar year that Fidelity kicked me out of all my commodity funds. They said they were too speculative. That was the best time to
be in energy.
Well, actually, no, not in 15. I was in energy from 01 to 2015, which that's the downslope that I sort of caught.
But then you
when they kicked me out, in
2020.
I found a way to get back in through that Fidelity account. I wanted to use that account, but then I sent off an email to about a half dozen fund managers who I knew well and said, okay, I owned it. In theory, that means I should buy it back. But is this offering me an opportunity to, take a break from energy? And they all said yes. They said, don't buy it. And it saved me a halving, I think. And it said, but in 2020, there were two things that triggered me to go back into energy. Unfortunately, not big and bold, because that's usually, it's playing Russian roulette. That's the deer hunter. You go big and bold, but at some point you blow your brains out. So you can't, the guys who go big and bold all the time end up losing their money.
Yeah. It's an expected value calculation.
That's right. That's right.
You might get lucky once, but over time, through an infinite,
you're going to blow your brains out.
Yeah.
So in 2020, when they kicked Exxon out of the Dow and replaced with Salesforce.com, I go, oh, that's a buy. So there's actually a tweet, someone that was from 2020, that said, give me one idea. And I said, I'm going to go with XOM, because they had just kicked him out of the Dow. And I said, that's a buy right there. That's it. When they kick Exxon out of the Dow, that means it's so out of favor. And it turns out it was right at the bottom. And so I moved into energy. But the other thing that moved me in is that energy had gone from like 2% of the S&P in 01 to 15 or 16%, according to Jesse Felder, who I get great wisdom from. And he pointed out in 2020 that it had gone back to about 2% of the S&P. This is the stuff that runs the world, as you pointed out. And I'm going, it's 2% of the S&P. This is insane.
Yeah.
And so with that, I went back into energy. Did I go in big? No, but I bought some more the other day because I listened to, I read the transcript of an interview of a bunch of guys from, one from Horizon Kinetics, guys I really like, one from the Copernic Group, Dave Iben, and they made the case. They made the case for the commodity bull market, which we've been hearing, right? This is not news, but they made it really well. And I have Gehring and Rosenzweig's. One of them was Gehring or Rosenzweig, one of those two guys too. I have money with Gehring and Rosenzweig. Again, enough to care, not enough to change my life. And so, but they made such a compelling case, and those guys are so good at fishing through that space, let us call it. I hate that term. But they fish through all the small cap commodity fund, all the small cap commodity plays, and they know how to do it. And they know how to buy the commodity, and I don't know how to do that stuff. And so I gave them, they have a publicly traded mutual fund.
Okay.
GRHIX, I think it is, GRHIX. Let me check that for your listeners. And I have located people who I think are really good within the world they hang out in. So Gehring and Rosenzweig is one of them. The other one is I have a very small amount of money with a guy named Eric Cinnamon, who's a small cap guy. And what I know is that he spends his days sitting on conference calls of companies with $200 million market caps. And I've sent him ideas, and it's clear he doesn't just bite at something. He knows what he's looking for. And
it's all about stock selection in commodities, because a lot of these names
that's right.
don't have any actual minerals in deposit, don't have any actual projects. They're just coasting off the fact that they're an energy play. So
GRHIX is the tradable part. You can also give them money. I don't know why guys do both. I think Cinnamon does. Cinnamon has. Let me give you Cinnamon's too. And I've exchanged emails with Eric a ton of times, and he is phenomenal at waiting for the fat pitch. So he is PVCMX. And so I spend months per year looking for the guys who I trust. I like Horizon Kinetics. At some point, they'll get money out of me. They have an infatuation with Bitcoin, which I'm not sure I want to get involved in. But nevertheless, so Cinnamon, let me give you
so here it is. So this is Gorian Rosenzweig's fund.
Yeah. And look at that. Look at 2020. That's when I started buying them right there. Wow. Right. So if that turns out to be the bottom, I nailed it. I like a Russian gymnast stuck it.
And what's interesting is if you look at, let's say, what is it? The commodity index. If you were just they've actually beaten the commodity index, because the commodity index is actually going down. Right. Whereas
these guys are dropped.
They're actually pretty much almost at parity as to where the top was in April 2022.
Right. So they've held up well.
Yeah.
If you give me my screen back, I'll tell you about Palm Valley. I can't seem to get out of it for some reason. Palm Valley, TVCMX. There's one stat I want to get.
Sure.
Holdings. Eric is sitting on interestingly, Eric is now distributing investments. He was 80% cash until last time I checked.
What is Palm Valley?
Palm Valley is Eric Cinnamon's publicly traded fund.
Okay.
And he might also have, give me a lot of money and I'll handle you separately type. A lot of these guys seem to have both. I don't quite know why. So he's now 20% consumer cyclical, 20% consumer defensive. He's got some utilities. He got some industrials. So he's playing the commodity stuff now.
Got it.
But he was sitting at 80%. And if you look at his chart, you can see what he did. Go to Max and you'll see March of 2000. So there's this fund, and he was sitting on just cash.
Yeah. So this is Palm Valley.
Now go to Max, hit Max. Right. So that blip at the bottom on the left, that was March of 2000. Yep. So when that drop occurred, he spotted things he wanted to buy and he bought them. You can see he wrote them down a little bit. And then it turns out he went back to heavily cash up on that flat part.
I see.
And whether he jumped the gun and is getting into stuff he shouldn't, but I'm watching him carefully because I just love the way he does it. He's not a momentum player. He waits till something is the right price, and then he buys that and he follows something like 200 companies.
Yeah, it's very much less volatile.
But I pay him to sit on his hands. He's not sitting on them right now. That's news to me, actually.
Yeah, over the last week or so.
Decent. Yeah.
Like he made some big moves.
Yeah, and he went down. And so he caught another blip.
Well, for now, right? I mean, you never know.
Right. So if I try to stock pick in a bull market, you can convince yourself you're a genius. When the cross currents are treacherous, amateurs like me get crushed stock picking.
Yeah.
I have to find some guy to manage my money, and I don't know how. I like the looks of platinum and the platinum miners.
Hmm.
Now, the reason I like them is because they've got nothing. The platinum miners have good balance sheets and high dividends and are getting crushed, and I don't know why. Sibanye, for example, SBSW. I spent about 6 hours this summer up in the Adirondacks chatting with the guy who owns the largest position in Sibanye, and we talked a lot about it. Turns out they were making their money off rhodium at that point. South Africa's a risk, and but here's the funny thing: platinum hasn't moved in 20 years. Platinum's a brick, but I can tell you why. I think the reason is for starters is because this idea we're going to get rid of internal combustion engines, which is a complete delusion in my opinion. It's got people scared that the catalytic converter will become irrelevant. They're also ignoring the fact that if we go to a hydrogen fuel cell based system, which strikes me as the best of the alternative energy vehicles, potentially. I'm not an expert. I'm picking this shit off the internet and from friends. It's platinum based. And if platinum somehow becomes a meme commodity, right? A meme commodity.
Yeah.
And someone decides to run it, it could go wild. And so I'm just, I have a good friend who's a money manager in London, and he is fanatically enthusiastic about platinum. And I think it's disappointed him so far, but I'm guessing he still owns a big ass wad of platinum.
Yeah.
Another one said, when I mentioned platinum in my write-up, I got an email from a guy everyone knows. And he said, you're the second person to say that. I have to look into platinum.
Interesting. Yeah, I don't hear much chatter on platinum.
Well, so that discussion with Rosenzweig, Gehring, and Iben and these guys, no one mentioned platinum.
Yeah. So here's the platinum chart for those wondering. Yeah. So
I mean, that's a pretty disappointing chart, isn't it?
Yeah, it's been pretty much down in the dirt for quite some time.
So I owned it since back in like 2004. So and it's a tiny amount, a truly tiny amount. If I lost it all 100%, it just wouldn't. It wouldn't even be a bad day. I mean, I could have a net plus for the day, right?
Yeah.
I bought RSX years ago, and then was getting ready to get serious about it. And then one day Grant Williams mentioned it as a contrarian play. And then so as the Ukraine war, with the drums of war were picking up, I got serious about RSX. So about 2 days before they shut it down, I made a play and I lost it all.
Yeah.
I'm not even sure I was negative on the day because it was a small enough position.
Mm-hmm.
But I still think it was an interesting idea. But the fact that the Western bankers confiscated it, I mean, okay, so now the Soviets are the bad guys, we're the good guys? Explain that to me.
Yeah, apparently. But if you thought the platinum chart looked bad, look at what happens when you price platinum and gold.
Right.
It's even worse.
So, well, but therefore, when I bought gold when I started buying gold in 90, I bought it from 290 down to 270. The NASDAQ was roaring. I couldn't keep buying it. It went down to 256. But I was feeling so much pain and I was in pretty strong, stronger than I would normally be. And then I started, once it got over 300, and I had buddies at the Prudent Bear chat board saying, oh, you got to sell. I said, no, I'm not selling. And I bought it as it sort of got back out of the basement. I bought it up to around 457. I remember that number because I was buying from a coin dealer. I had a standing offer. Said, you get gold coins, I'll come down and I'll pay cash for them. And so I have a lot of gold that is off the books completely.
I see.
Now, getting it back on the books is a questionable thing, but I've got it. Yeah. So in any case, I was buying it at 457, and the coin dealer who said to me, he said, don't you think this is a top? He knew I was going to buy it, so he didn't care. He said, don't you think this is a top? And I said, well, how many people are buying gold from you? And he said, 4. And I said, and the other 3 are friends of mine, aren't they? And he said, yeah. And I said, I told him to come down here, right? And he said, yeah. I said, does that sound like a mania to you? Because you know, the lines around the block model sure wasn't being, that box wasn't being checked. And so I went to 1900, and then I got to experience the joy of it going back to about 1,000. Silver really, you know, was a heartbreaker going to 49 and coming back, but and a bunch of that, not as much though. But then I bought some more at 1,200, and that's worked well. I decided it seems to have, I'm not a technical guy, but there is some sense of bottoming, right? Where it just becomes kind of dull. Like, okay, I think it's done being exciting to the downside. I could easily imagine buying some more now. I could imagine saying, look, the world's getting too screwy. I'm gonna get, but I'm probably 30% gold. My entire net worth is probably 30%.
Oh wow,
That's a big position. And
like gold, like just physical gold, or like gold
well,
miners?
I have central fund. Now I have very few miners, and I this year I wrote that, you know, they've been disappointing. I said, if at some point you see me talking about buying more miners, send me some hate mail. And I said, they just, the miners, here's what bothers the hell out of me. The miners, I gave a CEO hell on this one. The gold went from 256 to 1,900, then settled back at 1,200. That's still a good return, right? So my portfolio over the last 20 years, even though I was on the sidelines of much of the opportunities in from 2009 up, I still beat the S&P by 2% a year. But the miners, and I own some, but very, very little really, they gave it all back. How does gold go from 256 to 1,200 through 1,900 and have the miners give every penny back? And the bottom line is that the guys who ran the mines blew it. They just blew it. They invested way too much in exploration or whatever, and then gold went down, and then they had to regroup. The miners, Fred Hickey's out there beating the drum. Fred's a smart guy, and he's saying the miners are dirt cheap. I have people say to me, you know, well, it was easy to buy gold back in 1999 because it was so cheap, and I go, there were 5 of us who wanted to buy it. Right, in the entire, I couldn't identify more than a half a dozen people in my network of people who were saying buy gold. Bill Fleckenstein saying buy gold, right? That's not easy to buy. That's hard to buy when no one wants it. But then I was doing a podcast, one of the earliest, with a couple of guys, Collum Economics Report, and I said something has changed in the gold market. And they said, what? And I said, well, the Bank of England announced that they were going to sell more gold. And instead of driving the price down, the price went up. And every time they'd announced gold sales, the price went down before. And I said, then they actually sold it and the price went up again. So the Bank of England has ceased to do its magic on the price of gold. And so something has changed. And that was somewhere in the like high 200s. So that was the brown bottom or something they call it, just to be crude, I guess. And so you really do have to get a hated asset and then ask, why is it hated and is that valid? Yeah. And so if you put a gun to my head and said, look, you got a lot of cash. I got a lot of cash. Eventually it'll kill me. Put a gun to my head and say, what do you buy? I'm commodities. I'd be in various forms of commodities. That I buy into the commodity model.
So would you say that commodities are the most hated asset
well,
class
they're not
right now, or is there something else you'd say is hated? What do you think is most hated right now?
Well, platinum for starters. What's most hated?
Commercial real estate.
Well, I wouldn't be buying that right now. You know, that's got some shaking out to do, right?
But the fact that you said that, maybe that's not the case.
Well, except for the fact that their leverage has not unwound. So I think there will be, you'll hear audible explosions before that story's over. So and because the guys who do commercial real estate effectively have balloon loans, right? They're not getting 30-year mortgages. They were using, short end of the curve to finance it. So every day that we sit at 5% is a day that they're getting crushed. And so, and they over the next, Bookfire says this, over the next 2 years or so, these loans are coming due. These debts are coming due, and they're going to have to roll it over. And they're going to they BlackRock, Blackstone. I can never keep those two separate. I know it makes me sound like a complete idiot, but I have trouble.
Yeah.
Larry Fink's guys.
BlackRock.
They were getting money, which is really shows you the corruption of the system. Supposedly they were getting money at 0.15%. They should not be able to get money at 0.15%. That means they're getting it straight from the Federal Reserve.
Yeah. And so that was back in 2020, right?
Right. And so I think those, supposedly a dozen years ago, there were no sort of what's called permanent capital funds with residential real estate. There were just none. So when the housing market produced massive supply by the sell-off and the repos and stuff, I wondered where the inventory went. And it turns out it was all these guys with big money. And so residential real estate is a lousy investment. So you want to make money, you build a rectangular box, house 500 families. And that's how you optimize. To rent a McMansion to someone, it's very hard to make money. How do you do it? Well, first of all, you buy it on fire sale, check, right? They got it in 2009 when they went on sale. You buy it with unbelievably cheap credit, check. And then you leverage the shit out of it. So you take a razor thin margin and you just leverage like crazy. Well, those are going to unwind, I think. Yeah. Maybe I'm wrong, but put it this way, I'd stay out of the way. And the real estate market hasn't even begun to correct. I mean, it might have begun actually. It might have begun, but people say, "Oh, it's a tight market." I go, "No, it's a necrotic market. It's a market where buyers and sellers are not price discovering. The sellers don't want to sell for the price the buyers want to buy, and the buyers can't buy because the rates are not 5% instead of 3, or 6 or 7% instead of 3. So it means you can only buy half the house. Yeah. And therefore the price has got to come down. But what
about if you look at like housing starts over time, we're still at somewhat of a supply deficit when it comes to real estate.
Right. But I think it's because the system's locked up with people who just don't want to sell. Mm-hmm. And at some point they're going to be forced to. And they're really going to when it finally. So I heard from a realtor in Ithaca that although the supply is tight, the prices are starting to drop. That's a funny combination, right? That low supply dropping price is not normal.
How does that work?
Well, what it means is that no one wants to sell at these prices, but the people who have to sell are now having to cut the price. They're capitulating a little bit. And then if you're sitting on a second house, or a house is too big, or you're too levered, or whatever, or you have an adjustable rate mortgage or whatever, at some point you're going to say, I have to get out. And then the supply will start appearing, and then Barry Sternlicht will sell shit. And then next thing you know, there's a supply problem.
Yeah, I think I saw like a stat or something about people beginning to refinance their 3% loans to whatever the current rate is, 7%, I believe it is.
They can't.
Yeah.
They can't. They got to get rid of the house.
Yeah.
So it means you can't move, right? So let's say you have to move. Let's say you have job opportunity, and all of a sudden, there's a reason why realtors exist. That's because people have to sell their houses. People have to buy the houses. So if we have an economy where houses are not moving, it's also a very stagnant economy.
Yeah.
Because not dynamic.
Because it's tied to credit creation.
Yeah.
And the banks use that additional credit as
but again, if I'm buying a house I'll walk into the realtor with my wife, and the realtor will say, how much equity do you have? How much money do you have? What's your income? Here's how much you can afford. And then your wife gets you to buy that house. And so you push it right up. Everyone does this, right? There's very few people who somehow don't end up getting their dream house. Now, if all of a sudden, because the interest rates and rising taxes and all sorts of rising rates, you, instead of being able to spend 600,000, you can only spend 300,000. Who's going to buy those houses if the average buyer can only afford half as much of the price? Crudely speaking, the price has to cut in half.
Yeah. So here's an article I just found a second ago. I haven't read through this, but the headline says 20% surge in mortgage refinancing in 1 week.
Why? That they're not doing it for some opportunity.
Yeah.
That's got to be a forced refinancing.
Yeah.
It's got to be forced. No one would refinance from low to high.
I think so. I think it's trying to say that as rates come down below 7, they're seeing it as a chance to pull out equity.
Who bought it at 7? Who bought it at 7? There was no real estate market at 7. That's when the market almost didn't exist, right? That's when the inventory was tight. So there's not, this is not, when I bought a house, my first house was 15 and a half. It slowly trickled down. The refi costs were so high that it turned out I had a 15-year mortgage. Never made sense to refi. When you did the math, you go, I'm going to spend as much to close on a new mortgage as I'm going to save. So there's no, so then I 6 years later, I bought a house upgrade, and interest rates were 13 and a half. And by the time I closed, my mortgage had dropped to 9 and a half. Mm-hmm. So while I didn't own the house, but had a legal commitment to buy it, that house appreciated like crazy. And so I probably made 30,000, 40,000 on that house, just not yet owning it.
Just by closing the deal.
By closing the deal. And then rates went down to what? What was the 30-year mortgage? 3%, 2.95 or something, right? What was the lowest 30-year mortgage? And so now everyone got those. So a refinancing at 7% is not because you bought it at 9. Those guys all refinanced.
This is
what they're doing. I think here's what could be: they might be pulling equity out of their houses because they can't pay their bills.
Yeah.
So they're saying we'll take a 7% mortgage and we'll skim off, $50K, and we'll pay off the credit cards, which were up to our ass in debt.
Yeah. I think like 7% was like getting below 7% was like a magic number to some people.
But no one bought houses when the rates were 7%. Mm-hmm. The market was frozen. So there can't be those expensive mortgages now getting better. So if they said there's a lot of new mortgages at these numbers, I'd say fine, but not refis.
Yeah.
Here's the other reason. Bookfire said something interesting. Commercial real estate. Here's an opportunity. I was on a panel discussion with him, but had a lot of time to chat. And he talked about open air malls, which are the old strip malls of the past, and in Naples and places like that where it's warm. But the closed air malls have all died. But he made reference to open air malls being an opportunity. And I said, why? And he said, because the open air malls have stores that you have to have, like a dry cleaner, a liquor store, things like that. The closed air malls, if you think of what was inside those, they're all expendable stores. Mm-hmm. And so the open air malls are the kind that are likely to stay occupied.
Yeah, like
a hardware store,
shopping centers,
things like that.
Yeah,
shopping centers. Yeah, plazas.
Yeah, the stuff that you can't replace with Amazon.
That's right.
All these other department stores.
Right.
Interesting.
Okay. But I wouldn't buy those right now either. We haven't begun, and they're talking about, some expert will go on TV and say there's more pain ahead. And I go, what pain have we experienced? Explain that to me. Where's the pain?
Yeah.
To me, I'll tell you what pain will be.
This has been
it's not started.
Yeah.
It's not started. We had a dip. We had a correction that corrected nothing. We're at all-time highs.
Why is that? Why do you think we're at all-time highs at the moment?
I wrote about the subprime crisis in 2002, just picking up stuff from guys like Bill Gross and stuff. It took 5 years for it to register. And then I was standing in front of my class in March of 2007, and I turned to the class, one of my Tourette syndrome-like utterances, and I said, the banks are about to collapse. I just said it, blew it right out there, no warning, and the kids are like, what? I said, yeah, I think the banks are about to collapse now. I was watching the market ABX index. I was reading a woman named Tant who was talking about chaos under the surface in the pipes, and it was clear. And then it took 2 years to get there. So it's like putting a block of ice out on the sidewalk in the dead of summer. It's not going to be a block of ice, but it takes time. It takes time because of muscle memory. People just can't wrap their brains around the fact that I have the markets at 120 to 150% over historical fair value.
Yeah. I saw a tweet from Brent Johnson a couple of days ago, and he basically said that the Fed essentially has already cut rates without cutting rates. And what he means by that is that you've already seen the effects of rate cuts being priced in. So Powell at the moment, he's essentially brought back the conditions of the zero bound days without actually going down to the zero bound and keeping it at 550.
Well, except for the fact that the markets will quickly change their tune if he turns out to have more of a spine than people think.
Yeah, I know there's some people that think so.
Someone pointed out his wording. Someone said, if you look at what he said very carefully, what you see is him maybe mouthing the Federal, the FOMC's opinion, but not his. And he's still running that operation. So he might have been doing a concession to his other board members when in fact he doesn't intend to follow through. He didn't talk like it was his view. And I haven't gone back and looked, but I trust the guy to have paid attention. But he said it was cryptically not about him. And he had said the word pain many times. Where's the pain? I mean, if Powell can't take this level of pain, then he's a total pussy. I mean, he's just beyond. So there might be pain in the pipes, right? There might be things blowing up that haven't yet been detected, right? When the 4 big mother regional banks blew up, I was stunned that didn't start the cascade. They must have spent a ton of money getting those guys out of trouble. Yeah. And I don't know how. I know they set up some new plan with some alphabetic program, some maiden lane equivalent thing to swallow them. But there are still regional banks and big banks. They say, Bank of America is $200 billion insolvent. How do you fix that besides just ignoring it? That's like the breast lump. So you say, well, now we'll just pretend like they're not 200 billion in the hole. But at some point, they are 200 billion in the hole. And the Japanese banking system suffered from that, where they just pretended like everything was okay. And therefore, what happens? Well, you end up with a banking system that's stagnant. Because Bank of America is not going to be lending a ton of money if they're 200 billion in the hole, right? They're going to be tight.
Yeah.
And so I for some reason, there's been a delayed reaction. And I don't know why, but if regression to the mean in equity markets, and look at the top dogs, right? The top dogs are 7 companies that are a total load of crap, in my opinion. NVIDIA's priced at 45 times revenues. Sun Microsystems was priced at 10 times revenues before they did a 95% swan dive. So 45 times revenues is an outlandish price. And according to Hickey, they've done okay because of the rush to AI. They sold a bunch of way overpriced hardware to companies desperate to get it because AI had to be gotten. And that's going to go away. And so I think that picture of the CEO, that I don't know what his name is, he reminds me of Bill Hwang. I think that picture of him as, sort of iconic, he's going to be the poster child of the bubble.
Yeah. So if you look at, I'm trying to pull it up now. If you look at the world stock index and you compare that with, say, the S&P or the Dow, the S&P and the Dow, the American markets are highly outperforming the world markets. So could it there's another
thing going on there, though. the Magnificent Seven. By the way, let's take, for example, Microsoft, sort of a blue chip. Microsoft gains in the last 10 years have been spectacular. Fivefold of that, fivefold is valuation expansion. That's not real gain.
Yeah.
That's a mean regressing. They'll do a fivefold slice of valuations at some point in the future. Whether they grow out over an unbelievable period of time, which is like 50 years, or they give it back somehow. But so when you get fivefold gain out of valuation expansion, a tenfold gain doesn't look that impressive.
Yep. So here's the S&P divided by the world stock index. And it's just been, we had a bit of a correction, but now it seems like capital's flowing into the United States as more uncertainty kind of takes hold across the globe. So I wonder if that's the case, if it's just a matter of global foreign capital coming in and propping up our markets as everything else gets worse.
So here's a staggering stat that I saw. Something like, of the world index, the Mag 7 has a market cap that is bigger than the world index of 4 big Western countries combined. I just saw that yesterday. It's a staggering stat. And so the Mag 7 is going to be chapters of books. They're going to be writing about them. They're going to be the Nifty 50. They're going to be the FANGs. They're going to, it's just, but they're not. And so boot up. Can you boot up something like Case-Shiller? Can you boot up something like the Case-Shiller index? If you look at any valuation index or Buffett, price to GDP or whatever, or if you go to, actually, I've got some great charts on my Twitter feed, top link.
Okay. Do you want to pull them up, or should I?
I don't know how to do this. So if you pull it up,
I'll pull it up
and go to the case for 20-year bear market. I'll tell you how to find it.
Okay. All right, let me share my screen. All right, so
click that top link right there, that one. Yeah. And then search Ron Greiss. Search Greiss, Greiss. Greiss. He owns what's called the Chart Store. The guy's a great chartist. This is slow.
It is. I don't know why it is though. I don't think it's my connection. I think it's their page. Here it is.
Yeah.
What do you want to look at?
Well, I don't know what this is. I don't know what. Now search Greiss within the document.
Oh, like a Control F. Okay.
Yeah, Control F. Yeah.
Come on. All right.
Right. So now search Greiss. Okay. So here, go up first. Let's start. I got a last couple of charts that I want to show you. Go up. Okay. Let's start right there. That's the Dow from 1900 to 1940. That's a correction.
Yep.
Now, my definition of a correction is twofold. One is that it corrects price, sends prices earthward, and it corrects investor attitudes. You just pointed out a correction that completely and utterly failed to do either.
Good point.
10% corrects nothing. You need to grind investors' attitudes down to earth. And the last time we had a correction that really did that was 67 to 81. That's a correction right there. When Bernanke talks about the failure of the Federal Reserve in the 1930s, he completely ignores the fact that the Great Depression was ushered in by the 1920s. That bubble and it was also a consumer credit bubble. That's a staggering example of what a correction does. Now scroll down. That chart is blue is a 2%, 2.5% growth in the GDP. The market cap is something like 120% overvalued. So that shows that the market cap pulling away, and then it shows the paths to go back to just fair value. And if you go down A, it's like a 60% correction. Go down B, it's like a 20% correction, but it takes 25 years. C, to tread water, takes 35 years. D, to actually get a 20% gain, takes 50 years. Once you are up at 120% overvalued, there's no safe way home. There is no way to get home without pain. That's amazing to me. Now, go down one more step. That is the peak to trough. Those blue arrows represent inflation-adjusted Dow. Peak to trough. Look at that. Those are 40 to 75-year-long arrows. So if you're a buy and hold guy, if you own at the peak and you're sitting at the trough, 75 years later, the price hasn't changed. All you got was dividends. Now, over that period, dividends dropped from 6.5% to 1.5%, which means we are threefold, fourfold overvalued. Now, one more plot. This was sent to me by Grice. This is the inflation-adjusted Dow, S&P. This is the S&P, and then in blue, it's corrected for inflation, but it's corrected using M2 money supply,
growth,
which really strikes me as a clean way to correct for inflation. And it goes nowhere over 100 years. The question is it possible that the capital gains in the markets are all inflation, and that all you get is dividends? Now, the interesting thing is, after I published this year in review, he sent me an updated chart that showed the total return. It's the same chart, but it turns out it does have an upward slope, and the slope is 3.79% over 100 years per year. And that's the dividend. Wow. But it doesn't include fees. It doesn't include taxes. And so all of a sudden you go, wait a minute, I just made about 2% a year. Now, Buffett in his 99 Fortune article said, and this is where people misquote Buffett all the goddamn time. Buffett said, if you want to know why markets go up and down in big secular ways, all you have to do is look at long-term interest rates. He said, if rates in a secular way are going up, then the asset markets are going to get crushed. And that's the 1967 to 81. When rates go down over a long period, asset markets rock. And so everyone converted that into when rates are low, that's bullish. No, when rates are low, you're done. You've squeezed the juice out of the orange. You've gotten all the gains, and now it's time for rates to go up again in a long wavelength credit cycle, the kind James Grant talks about. And when rates go up in a secular way, you're going to get crushed. When we were at, 2% or something on the 30-year, and Europe was negative, and you were looking ahead to decades of pain. You were looking ahead to decades of pain. Scroll down. What's that last one? I can't even remember what that is. Those are the dividends over that period.
Down to 1.44. That we're at.
Right. That's what you're priced to earn if Grice is correct and that the capital gains are all inflation. That's your real return right there, 1.44, what we're priced for now.
Wow.
So we can't win. And so I did a podcast a couple of days ago, and he said, well, why do valuations have to come down? I said, well, you're priced to get a terrible, terrible return. If prices don't come down, it's like buying a treasury that returns 2%. If the treasury market stays elevated for the next 30 years, you're still just getting 2%. And as a consequence, you really can't win because pretty much market participants think they're going to get double digits for the rest of eternity, which has never been the case. In Buffett's article, he said, by the time you account for everything, which he didn't account for taxes, but by the time you account for fees, real return will not exceed 4% in the equity markets.
So does this imply buy and hold simply doesn't work over time? Because this is what I'm getting out of it.
Well, it works. It just doesn't work at the level that people think.
In real terms.
A guy named Ed McQuarrie did the same analyses. Here's the thing that always bothered me. People say, well, equities always return more than bonds. I go, where's the efficient market? The efficient market would drive the price of bonds and equities to the right locations where they return the same. The arbitrage would do that. Mm-hmm. And it turns out that you get guys like Jeremy Siegel saying, yeah, that's what happens. Well, Macquarie from, I think he's UC Irvine, went through Siegel's numbers, went through 200 years of bonds and stocks and said equities return the same as bonds and stocks. Equities return the same as bonds. And so they do return the same. He said, there's an exception. Post-war, we hurt the bond market so badly. If you take out about 20 years of the post-war period, then equities and bonds return the same for 150 years. Benjamin Graham said the same thing. He said anyone who thinks equities return more than bonds is dreaming, delusional. I think he used the word. And what it is equity guys make a ton of money and then get crushed. And then all of a sudden you say, well, I really just should have been in a treasury the whole time.
Mm-hmm.
And the answer is actually, if you wrote it up and down, you pretty much tied treasuries.
Yeah. I think the key takeaway is that equity, the best way to make equities is essentially to time markets. I hate to say it, because when we were looking at the SPX relative to the M2 money supply, it was pretty much just moving sideways.
But here's the problem. The problem right now is that I don't think the bond market's cheap. I think we could have 4 decades of rising interest rates. And so, and 2 years ago, we had this case where the bond market was incredibly expensive. And we had the same situation where the equity market was incredibly expensive. So where do you hide? During the 08-09 problem, your equity portfolio crushed you, but your bond portfolio saved you. There is no white knight on a stallion coming in to save you in this market right now. You're going to get crushed from both. And so dropping interest rates squeezed out equity gains for 40 straight years. And resources from Russia squeezed out cheap resources to fuel the economy. And China sold labor at slave wages. And the demographics, the boomers and their wives showed up in the workplace. And we were a young population with this big bulge of people creating wealth, in theory at least. And during the period from 1981 to, this is a stunning stat, from 1981 to 2023, 4 decades, the market valuations, not the price, the valuations, which should just flop around and not move. They of course will move, but not everything would be reversible. That's a mean regressor if there ever was one. High valuations give way to low valuations, give way to high valuation. It just keeps regressing. The market valuations over that 40-year period compounded at 3%. 40 years of a 3% tailwind valuation expansion. So what happens if the next 40 years is 3% valuation contraction? And people say, oh, don't be silly, that would never happen. Of course it will happen, because high valuations give way to low valuations since the dawn of civilization. How long, when, I don't know.
Yeah, long
but
enough.
It will happen. It will happen. And then the question is that when the boom, and people talk about the wealth transfer of the boomers. This is one I really like. They say, oh, the boomers are going to transfer so much wealth to their kids. I go, how? So they have a McMansion. That's wealth. They got to sell it. Who's got to buy it? The next generation. They don't have the money to buy it. You got equities. Who's going to buy them? So to transfer that wealth, they have to sell that wealth to that generation, and they don't have the money to buy that wealth. So it turns out that because that wealth's inflated.
Yeah. And then
so
you have to pay capital gains on top of it.
Right. And so this idea that the next gen is going to buy the overpriced assets off you and then be rich when you transfer the overpriced assets to you, it just doesn't make sense.
Mm-hmm. Yeah. Well, fascinating talk, Dave. So glad you came on the show. This is one of my favorite interviews thus far. Where can people find you, Dave?
Well, I have an email that I do try to answer emails, but it's a little clogged this time of year. But It's at the top of my Twitter feed. I'll tell you. If you know I'm a chemist at Cornell and you can't find me, I don't want to talk to you because you're too stupid. But otherwise, I do try to answer emails. And my Twitter feed is David B. Collum. My pinned tweet is a link to Peak Prosperity, where I write one blog a year. How to market a blog, I write one a year, right? But
Yeah.
it's monumental. I essentially every fall write a book. And so it gets as high as 300 pages.
So you do like a 1 year review for Peak Prosperity?
I do a year in review for Peak Prosperity. And I've always wondered, am I wasting my time? But then I'll get an email from some famous person saying that was just amazing. And it's like, okay. So I keep doing it. I don't know if I'll keep doing it for how long, but